areas that cash flow. Can you give me like what are your top 3?
Yeah, I would say the states wise we love Texas, Georgia, Tennessee. Starting to look into sort of Midwest. We like Ohio, Missouri. Florida's always been up there, but there's some headwinds there.
Yeah, because you own there, so you experience it yourself.
Yeah, so the insurance rates are starting to tick up. It's still a great investment spot. It's just with climate change and insurance rates, it's kind of questionable.
Yeah, because I've had people on the show who deliberately chose something the last 3 years in Florida because it never got hit by hurricanes.
Right.
And then those are always famous last words. Whenever you use the word never. And then I have one friend, Botany Cape Coral. They lost I think like 80% of the shingles off the roof during the hurricane, so the house flooded from the top down.
Oh my gosh.
And this is just after they renovated.
Right.
They were just waiting. They were at a stage. They were just waiting for the cleaners. Because the house was already renovated. They're just waiting for the cleaners to have the furniture delivered. Right. So it had already just been completely renovated.
Oh my gosh.
But like the storm was that bad to knock off that many shingles that it made your house permeable.
Right.
So a flood from the roof down to the basement. So another gut job.
Yeah.
Right. So me personally, as much as I love Florida, I'd be very cautious because again, I'm risk adverse. I need to know somewhere I can always get insurance.
Yeah. No insurance, no mortgage, right? So.
Yeah, and then mortgages are inflating. Across the states. I've done some research in the states too. I know a couple of the major insurers. I believe they reduced half their portfolio in
Florida.
In Florida over the last few years, and that seems to be a trend.
Yeah, they're starting to pull back because they don't know what's going to happen to that state and some neighboring states because of, again, climate change. Dimitri, my head of investments, is the best one to talk about this because he gets more intimately in tune with that from a sort of institutional level. But my understanding is there are big notable insurers that have openly stated that Florida is an area of question for them.
Yeah.
But then the counter argument I always hear is well, that opens up the opportunity for other insurers. I'm like, well, how big are these insurers? And who's to say that they're just not going to disappear?
Right.
So it's touch and go. If a client really, really is adamant about Florida, we'll help you source there, but and we'll keep a pulse on it. I think we want to kind of also project insurance rates as well. That's kind of our forecasting is some of our forte, so insurance taxes, but we'll kind of keep a pulse on that.
Right.
But we want to educate them. We'll give them the sort of same sentiment as we are talking about now, and if they still want to move forward, then we'll let them.
Because in my research, I believe the insurer with the largest market share, at about 15%, and they're the fastest growing, is a state-backed insurance company.
Right.
Backed by the state of Florida. So backed by the taxpayer of Florida.
Yeah, and I think that was a byproduct of their insurance pulling out. But again, don't quote me on that. That was more of a Dimitri question. But I think that was a byproduct of other insurers pulling out.
Red flag. To me, it's a complete red flag.
They have to back their own. Yeah. Exactly.
Right? I can't. I'm not. That's too much. That's too much of a red flag for me.
Right.
Because I have almost all my properties have basements. Mm-hmm. So whenever we get one of those 100-year storms that keep coming, I worry about my basements.
Right.
Right. So I've had enough worry in my life. I don't want to every time I hear about a hurricane coming to Florida, I don't want to be Googling and researching to see if it's coming near my property.
Right.
That's me personally. So I'm down to invest in areas where things make sense.
Yeah.
Right. So what about Texas, Georgia, and Tennessee? What do they have in common that makes sense?
Yeah. So the reason why we like Texas and we like Dallas a lot. I mean, those, like you mentioned, economic fundamentals, growing population, job growth, household income, unemployment rate. Those, we look at all of those factors. We plug into several hundred data points. So we like them because, they're great for, they run the gamut. They have anywhere from, your institutional grade class A, these are low risk homes in very nice neighborhoods, to The tertiary markets where you're looking at higher yield and lower price points. So they've got a good array of those, both areas. But I would say Dallas and most of pockets of Atlanta, they got a lot of great A and B product. And that's where a lot of institutions are buying up in droves. They're buying a lot of homes because they know it's very a good rental demand, appreciation. Same with Atlanta. Atlanta's home to a bunch of Fortune 500 companies. It's a growing population. You could buy something that's 2,000 build, 1,500 square feet for under 300,000. So great product there. So yeah, it's close to major metro. It's like a bunch of Hamiltons, right? Like it's a good city, great economics, good job growth. It's got all the right factors.
All these are a lot bigger.
Yeah.
I saw Atlanta's greater area is about 6.1 million.
Yeah, like Atlanta proper, I think. Yeah, it's about 400,000, but like the whole surrounding area. Yeah. There's such nice pockets there, and as much as institutions kind of affect owner occupancy inventory because they're buying up for rental, there's some benefit there for other investors because they can help boost the rental rates and stuff like that, and they tend to keep a good upkeep of their homes. So those are all positive opportunities for other investors to sort of leverage and piggyback.
Right. Can you give a range of price points for these A, B, and C class properties?
Yeah, so we go from anywhere from $50,000 homes, which would be like the tertiary
condo parking lot,
C,
parking spot,
the C class homes to up to like let's call it 400,000 for A class homes. And how you want to think about it is the A class homes have modest to low cap rates, so we would look at the pencil those deals to kind of break even, but they've got pretty aggressive equity appreciation year over year, and less tenant turnover. Some of the cost lines are a lot lower, like the allocation for R&M and vacancy are probably lower, and then on the C side, lower price point, lower appreciation, but higher yields, cash yields, higher risk too. So it's not to say we favor one or the other. I think a well-diversified portfolio should actually be a spread across that. And having good cash yield, sitting on that cash and reinvesting it into the A, it's a great cycle. Or even, refinancing and buying cash flow heavy homes is, a good opportunity too. So, yeah, a well-diversified portfolio, you should run the gamut. Each state has their A to C's, but they also have their sort of microeconomic factors. So that's why on our platform, we're like, it's a good idea to diversify across states, right? B's here, B's there, B's across Sunbelt,
right.
Midwest, yeah.
In case a red state becomes a blue state. No,
yeah.
I don't want to get into politics.
Or if a hurricane just all of a sudden pops up out of nowhere. No,
yeah, tornado. But again, like, this all sounds great. Anything else I haven't asked? We're running out of time. So anything else I should have asked? You want to share? The question I wanted to ask is, why single family rentals?
Right. Yeah. So single family rentals are like, after the 2008 mortgage crisis, they became quite popularized and known as like a very safe and resilient asset class. The reason institutions haven't touched it is because it's kind of hard to operationalize because you have scattered. That's why they prefer multifamily condos. But single family rentals, strictly because of the resiliency of it. In the up market, the price point typically goes up. And then in down market, rental demand goes up. So your rental rates can go up. And because of specifically long-term rental, not short-term, so that way you get people signing longer leases. You can have a dependable, repeatable monthly income to ride out down cycles. And then in up cycles, obviously you've got accelerating vehicles like refinancing opportunities and stuff like that to replicate. So after the 2008 mortgage crisis, institutions realized how resilient this asset class was, and they started entering on droves. And it is still one of the most resilient ones. And what makes them resilient is not just like, okay, it's a single detached home, it could be anywhere. No, it's a certain surrounding set of, again, economic fundamentals where you want to be outside of major metros, certain radius, drive time, rental demand, percentage of home owner occupant versus renters. These are all factors that go into the classification of an SFR, single family rental.
Awesome, Andrew. And then I always have to give my guests, a chance to share. Is there anything you want us to share about anything today? Without me prompting you?
Yeah, like I think a lot of questions, a lot of hesitation people get is like, do we buy now or do we wait for later? And I've always been a strong proponent of like, look, single family rentals is a 10 to 15 year hold minimum. Like that's how you want to look at it. Timing the bottom is impossible, and supply is dwindling. We are constantly bidding against institutions. So that's a big, like you can Google like funds deploying more capital, and they're, a few months ago, Blackstone just announced along with a KKR or something that they've raised another $110 billion to deploy in single family rental homes. So if you can pencil a deal today to be cash flow positive, everything kind of goes up, like everything improves over time as interest rates kind of subside. So you've seen the worst case scenario. Right. So lock in your assets, buy them now, because in 10 years it's always the same sob stories. Like, I wish I would have bought more. I wish I would have bought. I wish I would have bought. Yeah. But yeah, so if you can make a deal pencil today, snatch it up, secure it, and then ride it out.
Right.
And that's what we're seeing. We see savvy investors still buying deals.